Welcome, everyone, to this episode of the Mortgages by Gretchen show, where I talk to real people in the field of real estate who are not only experts, but they are very generous and willing to share their knowledge and their wisdom with us here. The goal of the show is for you to gain some information and tips to help you reach your real estate goals and take some of the guesswork out of what to do or who to call and to guide you in the process. Today, I have Amiel Jelinek with me. And Amiel is a mortgage broker with the Windrose Group team, which is the same team that I'm a part of, which is within Mortgage Alliance. And Amiel is a specialist in multifamily residential and commercial mortgages. And I partner with Amiel when I have a client who is looking at those areas in order to benefit the client with his expertise and the fact that he works in these markets every day. I met Amiel, I'm going to say 6 years ago, but maybe you can correct me. I'm not sure if that's exactly right.
Yeah, that's probably about right.
Yeah, it's been a while, and we've both been on the Windrose Group team. I've gained greatly from his sharing of his wisdom and knowledge and experience. Amiel's very easygoing, relaxed, and it's really easy to warm up to him and to realize he's really quite an expert, and he is definitely my go-to for anything with commercial mortgages. So Amiel, why don't you tell us a little more about yourself and what you do and who you help?
All right, that sounds good. Well, thank you for the great introduction, Gretchen. I appreciate it. So I'll give hopefully a brief explanation. Sort of back up a little bit. I actually started my career as an engineer. I think that's important because this industry and investing in real estate is a lot of analysis, right? So that's sort of where I got my initial background in analysis was from engineering. But back in 2012, I actually quit engineering and started investing full time. And this is what I was buying. I was buying multifamily residential properties, just like a lot of my clients are today. So in 2014, which is when we met about 6 years ago, that's when I got my mortgage license, kind of thinking that it was just going to be a side gig, but it has slowly taken over my life. So this is what I do, this is what I do full time. And it's about helping other investors, get to the same levels that I did, with buying multifamily residential, single family, like all kinds of different stuff. So I certainly have a lot of experience to offer and a lot of knowledge to share, which I'm happy to. So a lot of my clients are, investors, and a lot of them are, people that have been buying single family homes and the smaller onesie twosies kind of stuff. And now they're ready to upgrade, get into some of that bigger stuff, 6 to 10 units, even 20 units and above. So that's sort of where my experience lies.
Perfect. So that brought up a couple new questions for me. So one question being that you gave up engineering and went into investing. Did you have one or some investments, or did you have zero and you just said, I'm just jumping into real estate?
So I started, I bought my first property back in like 2007, but I was doing it very, very slowly. And then in 2010, I took some training courses and educated myself on how to invest in real estate and how to do it the right way. And so from 2010 to 2012 is when things just exploded. And I started buying, one property after another. And that's what enabled me to quit my job. So it wasn't, I'm a very conservative person. So it wasn't just, hey, let's quit and see what happens. It was, okay, I've got this base already, and I know that I can accomplish so much more by leaving my day job and doing this full time. So that was with consulting all my professionals and my power team, before doing so, which is definitely important.
Okay, excellent. And did you, you mentioned people starting with maybe a single family home or duplex, whatever, and then moving into multifamily. What do you think of people, it's sort of jumping ahead, but if someone says, I'm just jumping right into multifamily, let's not even do the smaller things, is that feasible, and can that still work, or are you thinking?
Yeah, it can. It's a great question. And you don't necessarily have to start with the smaller ones. And everybody is different, right? And everybody's profile is different. When you're buying, 1 to 4 units, that's residential financing. And lenders will want you as an individual to make up a lot of that income, because they always see it as a shortfall with a rental, right? So they want your personal income to make up for that. But on the commercial side, it's different. So if we're, true commercial property or multifamily residential where we're 5 or plus units, then it's more about the property itself. They want to see that the property debt services. So, so it could be a benefit to start with a multifamily. If you're somebody that doesn't have a lot of income or stable income, maybe you're self-employed and not showing a lot of income, it could be a great opportunity to start, on that multifamily residential side. What I will say, and what I'll caveat that with, is that if you're going to jump in and buy, a 100-unit building, that's probably not going to work, right? Like, they do want to see that you have some experience if you're buying those types of properties. But if you're buying, between 5 and 10, maybe even 20, depending on the price, then yeah, there's definitely a potential to get into that space right away.
That's exciting.
Great question.
I'm even thinking of some of my existing clients who are approaching their first property of, it's worth the conversation of, hey, have you considered a different approach? So very good to know.
Yeah, and it is very much about the property itself. They do look at you as an individual, but it's more from a credit standpoint, right? If you have good credit, then they know that you can handle your finances. They do look a little bit at your income, but it's more just to make sure that you have a buffer there, that you can handle yourself, that your personal life is not going to affect this building that they're lending on, right?
Mm-hmm.
Not that your income is going to help support the building itself.
Okay, and so another new question came in. If someone's jumping into that, or whether it's their first or third property, whatever, but they're getting that, let's say a 6 or 8-plex, do you recommend that always be in a corporate name, or could be in a personal name?
It can be in a personal name. My recommendation is always, is always corporate, I guess. I think that it is really relying on your power team. So my recommendation is going to be corporate, right? But it is important that you talk to your accountant, right? And it's important that you talk to your lawyer as well, right? To make sure that they're on the same page, right? We're just, as mortgage brokers, we're one piece of the power team, and you've got to get advice from everybody on your team. But certainly, on the commercial side, that's sort of what's expected, right? They're expected that it is going to be in a corporate name. So, versus the residential side, when we're lending on the residential side, it's a lot tougher to get things done if it's in a corporate name. We can certainly do that, but there are less lenders to choose from. Whereas on the commercial side, everybody is lending with corporate names.
Okay, thanks for clarifying that.
Yeah, no problem.
All right, so maybe tell us a little more about what's going on right now in the world of commercial mortgages and multifamily mortgages.
Yeah. So, so with COVID, there's certainly, there has been some changes, and it started out with lenders really tightening up, but they've certainly, loosened back up again in certain areas. So when it comes to commercial lending, there are different asset classes. So, one of those asset classes is multifamily residential properties. Another asset class would be like true commercial, like retail stores. Another industrial, right? So in terms of what lenders are doing right now, it really depends on what asset class you're in. So, a lot of the people that we work with are buying multifamily residential properties. It's somewhat business as usual for those types of properties. The only sort of difference is that they're really scrutinizing the tenant agreements. So it's one thing to have tenancies in place, but they also want to know, are people still paying? So with all the deferrals that have been going on, have you given your tenants deferrals, and are they now caught up again? Are they paying? What has that impact been? And they really want to look at what is that impact going to be, over the next few months. And it comes down to, are you going to be able to pay your mortgage or not? Right? That's what it comes down to. When we're looking at, sort of that true commercial where we're, retail stores, again, they've taken a big hit. Retail, office space, industrial, all of them have taken a big hit where they've had to close down, right? So similar to multifamily, but even more scrutinized is, who are the tenants? Are they going to be staying? Are they going to be able to pay? And a lot of times lenders are reducing, loan to value on mortgages because of the risk, and potentially not using some of the tenancies in their calculation because of that risk, or if they're not paying, that sort of thing, right? So it's certainly a case by case situation, but they are definitely scrutinizing deals in much more detail now.
Okay. And what's that communication like when you mention, what's the plans of those tenants? Are they reaching out directly to tenants, or is that through the realtors involved, or through yourself as the mortgage broker?
It's oftentimes through us as the mortgage broker, but they can certainly ask for bank statements from the current owner if you're buying, or your own bank statements if you're refinancing. Yeah, they're certainly, they can ask for more detail. So it's not like we can just say, well, everybody's paying. It's we need to have the proof, because they may ask for it, right? But oftentimes it's with the relationship that we have with the lenders. If we say yes, everybody's paying, then a lot of times that's good enough.
But you mentioned future plans, like are they going to stick around or something? But that's something that they really can't. Can't.
It's tough, right? But it's it could be looking at like, let's say it's an office space that you have, right? And you have a certain tenant in there. It's really looking at, okay, what is their business, and is this one of those tenants that's likely to downsize because now all their employees are working from home, right? So it's really looking at those aspects, really taking a deeper dive into it to see whether that income is going to continue or not.
Okay. And are you finding some lenders are more flexible than others, or is it kind of you learn on each new deal, or how is it?
It's sort of, this industry is always that way, right? That some lenders have more of an appetite, and it changes throughout the year as well. Certain times of the years, lenders are going to be really aggressive and say, okay, like, I'm willing to take a bit more risk because I need to get my numbers, I need to get my numbers up, right? Whereas other times it's like, well, I've already hit my targets, and so, I'm not as interested in doing certain deals. So yes, it is like that. And that's, that's one of the great things about working with a mortgage broker is that, we do talk to all the lenders. We know what's going on in the market, who's interested in what types of deals, those types of things.
Okay. And as far as lenders go, you're working with banks, but also non-banks, credit unions, what kinds? Yeah. All kinds?
All kinds. So we're banks, monoline lenders, credit unions, mortgage investment corporations, REITs, private funds, all across the board. So really depending on, what type of project you're doing will depend on, will determine what type of lender that we go to.
Okay. I guess that also leads to the question of why would someone work with a mortgage broker on this type of a transaction versus going right to a bank or the bank they usually do their other transactions with?
Yeah, that is it's a great question. Beyond the fact that, we do have access to all these lenders and we do work with all these lenders, what I find the biggest benefit to working with a mortgage broker, and a mortgage broker that knows what they're doing, is the way that we package things. So this is not one of those things where you send me documents and I just throw it off to the lender. It's you send me information, I analyze it in great detail, and I put together a package for the lender to show them why this is an amazing deal for them and why they should lend on it. So I've had clients come to me and say, well, look, I went to my bank and, I need, there's an example of one that happened not that long ago. They said, well, I need 1.5 million in order to purchase this property. And the bank is saying they're only going to give me 1.2. And I said, okay, well, let me take a look at it. So I looked at everything. They said, well, there's, it's a bit of a stretch to get to that 1.5, but I think that we can make it happen. So we went forward and we positioned it properly, and we sent it off to a few lenders. We actually ended up getting them 1.7 in financing to purchase this building. So they had, and this was one that they were going to be doing some renovations. So, they had funds to purchase the building, but then also some extra reserve that they could use towards their renovations, which was the plan, right? So
That's
So
a
that's
huge value add right there. Yeah.
for sure, and that's exactly it, right? It's especially when we're in this space, it's about access to money, right? Being able to get the money that we need in order to grow, in order to structure things properly and grow our portfolio, right? So that's one of the biggest reasons, why you would work with a mortgage broker. And like I said, somebody that knows what they're doing, because not all mortgage brokers do commercial lending, and it is a completely different space for sure.
Yeah. Well, that's a huge benefit to go from an option that's not really working for you to something that's above your dreams, beyond your dreams. So that's fantastic.
Yeah, that's what we always strive for. Exceeding expectations.
Dream fulfillers. Lovely.
Dream fulfillers. That's it.
Cool. So as an investor yourself, what are some of the things that you've learned along the way, and it's probably also in your role as a mortgage broker, that you can share about being successful in these asset classes, multifamily, commercial, or whichever one if you want to touch on?
Yeah, I think a couple of things that I want to mention are due diligence. So, when you're looking at commercial properties, multifamily, larger multifamily, there's a lot of due diligence involved, and it's really important that you go through and do all that due diligence, because when a seller presents an opportunity, oftentimes it doesn't match what the actual reality is, right? There's always some things that are missing. So making sure that you're taking the time to, go through the leases, go through all the expenses, making sure that everything is adding up properly, because that can have huge impact on your profits, right? And as well, it can also offer enormous savings for you when buying the building. So I always say that, that it's once you have an accepted offer, that's not the end of the negotiation, right? That's just the start, right? So you have an offer and it's accepted. That's when you start going through your due diligence. If you find some discrepancies there, that's grounds to go back to the seller and say, look, like, things are different. I want a reduction in price because things are not as they seemed originally. I was willing to pay that price when that was the scenario, but now that it's different, I'm only willing to pay this price. So there's certainly room for negotiation even after you have the offer accepted and in place. So that's one of them, is due diligence. And the other one that I would say that I've learned along the way, sometimes hard lessons, is really to take a look at that risk versus reward, scenario, let's call it. So while you might be looking at one building that might be in a smaller town, the numbers look great. You're like, wow, this is looking amazing. I'm going to have huge cash flow, and this is going to be awesome. Whereas, you look at another building that's in a major center where, the cash flow is not as great. It's to really look at those two opportunities and say, well, you know what? Even though on paper that one in the small town looks fantastic, it may offer way more headache than what I'm willing to take, right? So having maybe a little bit less cash flow to start, but much less headaches could be the better way to go. So I've certainly learned
less headaches. Maybe give some examples of what would be a headache.
Yeah, so a headache would be bad tenants, right? So if you're in a small town and it's in an area that's not that great, maybe you don't know the area that well, you can get tenants that cause a lot of problems, right? And so what that means is that your great profits that you had are actually going to go down significantly because you're going to have vacancies, right? So whereas in a major center, the vacancies that you're going to have are going to be minimal because there's always people that are looking for property in those, in those areas. That's sort of what it comes down to, is that more tenant issues is what I would say with that, with that smaller town type of idea. I'm not saying not to do it, not at all, right? But it's to really take a look at, sometimes it's even, sometimes it's better to take the lower reward to reduce the stress and headaches. Because even having a property manager manage the property for you, you're still responsible for the building at the end of the day. And it's your pocketbook that gets affected when things are not rented or expenses are higher or whatever the case may be.
Okay. And let's say someone comes in and says, oh, this is a property that needs some work and I'm going to improve it. I'm going to raise my rents and this is going to be amazing. Is that, there's probably not like a blanket answer to this, but Can that be feasible, or is that, obviously you have certain rules, especially during COVID, about tenants and how to handle that with tenants?
Yeah. Yeah. So certainly, you're right. It's not a blanket answer, but certainly I do love that strategy. I honestly really do. Taking a building, especially it could be taking a building in a better area that does need some work, getting it at a bit of a discount and then putting the work into it to improve it and turn over those rents and increase the value with the idea of refinancing and taking out, most, if not all of your original capital and renovations that you put into the building, right? There are a lot of people that do that on single family homes, secondary suite conversions, those kind of things, but it can certainly work on multifamily buildings. I think that you just have to expect that it's going to take longer than it would on a smaller building, right? It's not a 3 to 6 month project. This is likely a year to 2 years, depending on the size of your building. And certainly, like you say, with COVID and tenants, you have to be cautious of that, and a lot of times with that strategy, we're trying to, get the old tenants out and get new tenants in. And of course, there's, rules and regulations with all of that. So something that needs to be taken into consideration, but certainly something that, we can plan for in the financing, right? So if we know that you're going to be doing renovations and doing takeout financing down the road, then that's something that we plan for right up front.
Okay. But COVID has definitely not brought things to a standstill. I think you're pretty busy. And,
yeah. Things are extremely busy. So definitely COVID has not brought things to a standstill. It's just made lenders more cautious. That's what it comes down to. But if you have a good solid deal, we can get it financed.
And do you find your clientele, are you kind of like GTA Golden Horseshoe or beyond that?
We're pretty well across Canada. So, right now we see a lot of stuff. We are here in Ontario, so obviously we get a lot of stuff in Ontario, but a lot of stuff happening out east as well. In the eastern provinces, prices are low and cash flow is great, right? So it's definitely something worth looking at. And we have a lot of investors from like BC, Alberta, Ontario, investing out that way, which is really interesting. Yeah.
That's good to know.
Mm-hmm. Yeah.
Okay. All right. So I understand there is an option with commercial mortgage to insure the mortgage. And so what does that look like, and what would the advantages be of that?
Yeah, good question. So there's only one insurer that does commercial mortgages, and that's Canadian Mortgage and Housing Corporation, CMHC. And their mandate is to provide affordable housing for Canada, right? So they do offer mortgage default insurance for multifamily residential only. So they won't do, retail, office space, industrial, those asset classes, but they will do multifamily residential. They will allow a certain amount of like retail, like a mixed use building, but it has to be relatively low. Their main goal is to finance affordable housing for Canadians. So one of the benefits to having CMHC insurance is that potentially your down payment could be less. They will actually finance up to 85% loan to value on the multifamily space, which is amazing, right?
Yeah, I think because most people think it's 65.
Yeah, that's right. So typically with multifamily units on the conventional side, it's typically 75 to 80%. So with CMHC insurance, we can get up to 85% financing. There is a bit of a caveat there that is 85% of their assessed value. So you have to be cautious because they are conservative. And so if you're buying a building for, let's say, $2 million, they may not value it at $2 million. So you have to be cautious there a little bit. But if you have a building that's in good condition, at or above market rents, cash flow is great, then that's a great building for CMHC. If it's a building that needs work and, rents are below market, not a great option because they're going to value that property less. The other great thing about CMHC insurance is that the interest rates that you're going to get are much lower. So if a lender sees that it's CMHC insured, then it's basically no risk to that lender, and they're willing to offer a much better interest rate on your mortgage, and potentially even up to 1% less than what it would be conventionally. And right now, that means even below 2%, which is crazy.
Which is awesome. And the fee, it's not like on the residential side, right? It's not like 4% of, it's,
It can be, yeah.
Okay.
It's certainly a hefty fee. Depending on, it all depends on how much you're putting down. Also what your amortization is, that will affect the amount of the fee. But similar to the residential side, it's not like you have to pay it out of pocket. It is added to the mortgage. And when you do the calculations with the interest that you're saving, from a lower interest rate, you're usually much farther ahead with the CMHC. And I'm not saying that everybody should go with CMHC insurance. There's certainly issues with it, I guess. One of them is the value, the other is the timeline. They're typically like minimum 10-week turnaround times once you have all the documents into them.
And they're pickier, right? Kind of.
They are certainly, yeah, they are certainly pickier. So, it's always deal dependent, and that's again one of the things with working with a mortgage broker that knows what they're doing, is that they will advise on, hey, yeah, this is a great project for that, or no, it's not. Not a great project, and here's the reasons.
Yeah. And do they offer, if you're doing a refinance, is it going to be strictly based on current value, or can you do something on the sort of as improved or as renovated value with the ARV with the refinance?
Great question. So CMHC announced just back in the spring that they're no longer doing equity takeout. So if you were hoping to, show an increased value and take out, an extra 100, 200,000 to go do another project, they are not allowing that right now. Okay. So that's sort of a downside. They will still refinance you. So if you just want to refinance and get a better rate, rate on your mortgage, then for sure they'll do that. But if you're wanting to take out equity, then it's not the greatest option. It could be that, we'll do that with a conventional lender for a couple of years, and then we'll put you with CMHC insurance after that point to lower the rates.
Now, will they let you do the sort of like a purchase plus improvements though? Will they let you take out more based on some work that you're going to do on the property and do draws?
Yes. Yeah. They will. There's always lots of hoops that you have to jump through when we're doing it with them. But yes, they do construction financing, so that's absolutely definitely they'll consider that. Yeah.
Okay, but as you say, there's other lenders you can do it with outside of CMHC.
Yeah, and again, it all depends on what you want to do, right? Like if it's a project where you're hoping to, get, a huge uplift in value, where there is the potential for you to get not just your renovation costs, but also your original capital back, CMHC is not necessarily the best option for that. And it could be that we do potentially private financing up front to fund that construction if it's a major project, and then refinance you with a traditional lender to get, all that plus some back. Yeah. So each deal is different, and we, we go through all the pluses and minuses of each option as we go through it.
Okay, perfect. So what kind of temperament do you need, both as the mortgage person as well as the client, to be successful in this area?
So I think the biggest thing that I see is that, you need to be patient. This is certainly, and I see it a lot with people transitioning from, the residential side to the commercial side. It's a completely different world. Things do not happen quickly on the commercial side. So you have to be patient and understand that things take longer. So we're typically asking for a minimum of 30 business days for conditions on your purchase, where that's unheard of in the realm of residential financing, right? Even just having a lender submit, and we submitting documents to a lender and have them review it and provide an approval is like a 2-week period in itself. And that's after we've already gone through a bunch of back and forth, nail down, everything that we need and make sure that all the numbers line up and all that kind of stuff. So it's a much longer process, and people need patience. The other reason that people need patience is that I find that, that not every deal will go through, right? So somebody will start working on a deal, get into the due diligence, and then find, well, you know what, there's something here that, that I wasn't aware of, and, I'm not willing to proceed. So we've got to scrap that one and move on, move on to the next one.
So lots of consultation and planning and working together and working with the realtor as well and being a close team.
Yeah, absolutely, right. It's very, very key. So yes, patience, I think, is key when you're on this side of things.
Okay, so give us an idea of kind of the steps involved in the process and some of the costs to expect. Again, if you're used to residential, it's very different. So
yeah,
what does that look like?
Yeah, it is certainly different. So the process, we'll try and go through it in not too much detail, so not to take up too much time, but sort of the Coles notes, you make an offer, you get something under contract. Right away, that's when you start your due diligence, right? Once you have all those documents from the seller and you've gone through them, then that's when you want to send everything over to your mortgage broker so that they can start packaging it up for a lender, right? And ideally, you want to do that fairly quickly because that's the space where you haven't spent any money, right? So we want to get things off to the mortgage broker and off to a lender to make sure that we're getting the financing that we want before we start spending money, okay? So with your due diligence, there's a few things that are sort of different than residential. First is the appraisal. So we're always going to need an appraisal. There's no way around that. And appraisals on the commercial side are more expensive than what they would be on the residential side. So residential, we're typically in that $400 or $500 range. With commercial, we're usually starting at $2,000, up to like $4,500 in that range, depending on the type of building, the asset class, number of units, overall purchase price, that sort of thing. So certainly be prepared for that. Because we're talking about big dollars, the lender may want to see an environmental assessment. And so that environmental assessment just looks at, is there any potential for contamination on this site? And it does depend whether we need it or not. It does depend on where the property is located. So if it's next to a gas station, 100% we need that environmental assessment, right? But if it's in a residential neighborhood, then we may not. The other factor.
I've seen a case where it's basically a 2-page sheet that the client completed, and
Correct.
that pretty much was it.
Yeah, that's exactly it. So that's a lot of lenders will have that environmental questionnaire, and so clients will fill that out and just say basically no, we don't know of any environmental hazards, and that's sort of the end of it. Once we start getting into mortgage amounts, of more than $2 million, then there's a good potential that they're going to want to see that regardless, right? Just because of the dollar value and the risk that the bank sees as being applied to that mortgage, that they're going to want that piece of paper from a professional engineer that says, yes, I don't think that there's going to be any issues with this property. Okay, so there's that. The other thing that people that aren't sort of expecting that is sometimes required is a building condition report. So it's somewhat similar to a home inspection report, but it's actually more high level. So I look at it as similar to a condo reserve fund study. So an engineer will go in and look at all the high level systems like the roof, the foundation, the windows, doors, the HVAC system, the plumbing, and basically say, okay, well, this is where we're at today, and I think that these are going to last, X number of years, and if you had to replace them, it would cost this much. And so the bank can then use that to figure out, how much should we be allowing for capital expenditures down the road.
And how long is that? Let's say someone had one done a year ago. Is it possible to use that, or they start from scratch?
Potentially, yeah. Potentially, we could use that. It could be that we might need, if we got the same person that did that report to come in again and just confirm that everything is the same, or especially if you've done changes, then we need to show that yes, we've made all these improvements. If the report said that all these things needed to be done, then we want to show them that some of those things have actually been done. And so getting back to cost too, the environmental and the building condition report are usually around the same amount of money. It's usually around $3,000. And they're done by professional engineers. What else? So those are sort of the the due diligence that you're going to have to do as, you know, a part of getting your commercial financing. So that's sort of the process. And what we want to do is, you know, before we start spending money on that, is we want to make sure that all that due diligence is where we want it to be, and that you're comfortable with moving forward on the building before you start spending that money. Because once it's spent, you don't get it back. That's the bottom line. And it's big ticket items. So in terms of other costs, on the commercial side, the lenders will always charge a fee. And their fee is somewhere between 0.25% to 1%, depending on lender. As well, we don't get paid from the lenders in this space, so we charge a fee as well, and our fee is typically 1% of the mortgage amount. And then on top of that would be legal fees. So some lenders will also require their own legal representation. Again, sometimes it depends on the mortgage amount. But as a borrower, you'll be responsible not only for your legal fees, but also for the lender's legal fees.
Okay.
Yeah.
That's a good overview.
Yeah.
Awesome. Well, I definitely think anyone listening will realize the benefit that you bring to this process, and even talking up front before they make an offer is probably a good idea.
Absolutely. I think that if you're interested in getting into the space, it's certainly worthwhile having a conversation and, you know, get all your questions answered even before you start, you know, talking to the real estate agent and getting things rolling, just so that you know what to expect, for sure.
Yeah, awesome. Well, you had great value, so I'm grateful for this information.
Thank you, Gretchen.
And I have one last question.
Yes.
What would your last piece of advice be for Canadians right now?
That is a good question. You know, I think that you know, with COVID going on, right? We hear so much in the media about doom and gloom, and there's so much fear being put forward, right? I think that it's really leaving that fear at the door. It's not the end of the world. Things are moving along. So I think it's kind of curb that fear. And if you're interested in investing some money, you know, you can certainly do it in these times as well. There are lots of investors that are out there buying and making money, right? You know, if you're sitting on the sidelines, there could be some opportunities that you're missing. So I say leave the fear on the side, but proceed with caution, right? You should always be proceeding with caution, you know, regardless of time frame. But if you're looking at buildings and it makes sense from a fundamental standpoint, you know, with the rents that you're getting, you know, the expenses, you know, plus buffers, you know, you're still making money, you know, now's as good a time as any to get going. For sure.
Awesome. And where do people find you? Through me? Through other? What's your?
Yeah, I think probably through you, right? Just send Gretchen an email and give her a call, and she'll get us in touch.
Perfect.
Yeah.
Well, thank you so much. You gave such amazing information. I'm looking forward to sharing it with everybody.
Awesome. That sounds great. Thank you so much for having me on today, Gretchen. I appreciate it.
You're so welcome. You're a great human being. You're a great partner, and I'm so glad we know each other.
Me too. You're too kind. You're going to make my head expand too much.
Well, take care.
Okay. Thanks, Gretchen.
You're welcome. Bye-bye.
Bye.